just because you won one market doesn't actually necessarily give you that much natural advantage in opening the next market.
Being capital constrained for the early days is far better because we do think of unique solutions and different ways of addressing challenges as opposed to just throwing money at
I
it.
was like, this is ridiculous. And I talked to my son about it, my 10-year-old son. He's like, it's amazing. Can you pay for it? Welcome to the second episode of The Accidental VC, where we explore how operators and founders turned VC are looking at the venture ecosystem. Today, we'll be exploring how the venture ecosystem differs in markets like the US, Southeast Asia, India, and Australia, as well as looking at the big venture decline and issues that have been coming up in Southeast Asia in particular, and perhaps also the rest of APAC. And finally, how AI is affecting early stage investments. I give it over to my co-hosts, Shiyan and Dhruv, to kick off. Shiyan, you've invested heavily in the US and Southeast Asia. Maybe you can tell us a little bit about how you feel the venture ecosystem is different between those two markets for starters.
Yeah, I mean, I think, Southeast Asia, we're really still in the early innings of venture, right? So if you think about pre kind of 2014, 10 years ago, there wasn't really much of a venture ecosystem. And so the benefit of the Valley, separate from sort of the depth of the US market, is that you've had so many generations of founders, investors, service providers, and all of that experience and knowledge and capital, feeds onto itself. Whereas I think in Southeast Asia, we're kind of still in the first generation and a half, right? So you've seen some early exits, and those people are starting to recycle back into that ecosystem. But even for the investors in the ecosystem, most people are relatively new, and this is their first business cycle. So I think from just a maturity of the market, I think that's one big difference. And then the second is the US is one market, right? Like one set of federal regulations, one currency, one language, whereas Southeast Asia is 11 countries, but maybe really 5, 6 major country markets that people are in. So that's 6 sets of regulators, 6 languages, 6 payment methods, at least, right?
Religions?
More than 6 religions, for sure. And so that, I think, increases your surface area of complexity, I would say, is how I think about it. So I think when people are trying to stitch together enough market size to generate what they consider a venture scale outcome, it requires them to have a lot of operational complexity in their businesses. And so I think those are some of the challenges that we think about when investing in this region, which is like, just because you won one market doesn't actually necessarily give you that much natural advantage in opening the next market. Of course, you can say like, yeah, my tech team, I can scale the software, but you still need, to go talk to a different set of regulators. You still need to have people who speak different languages to open that country, different sets of partnerships. So I think it presents a longer timeline for businesses to get to scale because of the heterogeneity of the markets.
There's some good insights in them, maybe specifically because of Hustle Fund's sort of focus between US and Southeast Asia. How do you look at it from a portfolio allocation point of view? And because you invest in early stage startups across both markets, right? Do you have a lean towards saying, okay, because of the GDP in the US versus Southeast Asian GDP, we cut it up this way? Or how do you look at sort of allocation between the two within that context?
Yeah, great question. So our portfolio is 70% North America, 30% rest of world. And rest of world is majority Southeast Asia, but we actually have a handful of companies in Latin America and Africa as well. And so we actually think of emerging markets as being much more similar to each other than to the US. So like a fintech in LATAM, I think is more similar to a fintech in Southeast Asia or Sub-Saharan Africa than it is to a neobank in the US, right? In terms of purchasing power, in terms of the mobile first nature of how they operate, all of these things look much more similar to each other. And so funds are 10-year funds, right? So if you believe that over the course of 10 years, critical infrastructure has to be built in these markets, and you can find good teams at reasonable entry valuations that can go out and build those things, we still think that's a worthwhile endeavor. If it is another sort of Me Too copy of something from a developed market, and it doesn't actually have much differentiation or not much respect for local conditions, then I think that's less interesting for us outside the US. Um, in Southeast Asia, less so because I actually think there's quite a lot of capital in Southeast Asia, but there are markets in Africa and Latin America where like the availability of capital relative to the talent and the market opportunity is mismatched. And so there are opportunities to get into some of those companies pretty early at a very compelling valuation.
Makes sense. And Dhruv, you've come up through the Indian ecosystem and have done great things there. Sold the company to an Australian company, I suppose. That's right. And I guess you've invested in both. At least I know you've done many in India, of course, also in Southeast Asia. Don't know how deep your exposure is in Australian startups. I've done just a handful myself. But can you tell us a little bit about hearing also what Shiyan said your experience has been like in investing in India versus Southeast Asia, US, and Australia, perhaps?
Well, I think, just to kind of add to what Shian basically said, I think, when you look at Southeast Asia, people tend to sort of look at it as a single block. And actually correctly said, it's not a single block, but 6 different countries or more, with its own set of complexities in terms of border market regulations, etc. If I look at India, it's pretty much the same size in terms of its GDP. If you look at the entire sort of Southeast Asia together, but we have much less complexity relative to Southeast Asia, it's a single market. Yes, we do have regional nuances within India, but at the end of the day, it's a single national regulator, and many of the regulations which impact businesses tend to be pretty homogeneous. So I think in that sense, I like the fact that it's a single market relative to Southeast Asia. I think if you look at just the sort of ecosystem, it's evolved considerably over the last. I think I started my first company back in 2006. So in the last 18 years, it's significantly changed. I would say Southeast Asia is probably 7 to 8 years behind where India is. In terms of the availability of a capital, I think there is a very vibrant angel ecosystem, pre-seed funds, seed funds, all the way until growth fund. Yes, Series B, Series C, and pre-IPO capital is still lesser compared to the US, but we're slowly getting there. I think in terms of just talent, I think that's again where if we look at India, with an emphasis on STEM education, we have high quality engineering talent, and that makes it much easier for companies to get things off the ground. Again, in Southeast Asia, there's disparate talent across different countries. So that again, element plays a role. I think where again having sold a company to an Australian company, big difference we see is that in India today, despite the size and scale of the market, it's still very, very hard to make big margins. So many companies which are listed IPO in the market in the last couple of years are still sort of struggling to get to profitability or operating on very thin margins. And whenever there is strong revenue growth, you see the margin compression and vice versa. So I think that remains a challenge. Unlike Australia, where despite the small market, while we might not scale revenues to the levels we have in India, but because of purchasing power, willingness to pay, the margins are much higher. So that's I think the big difference. So I think that there is a natural sort of evolution which venture investing sees because of how the markets evolve the majority of the market. So I'd say if we compare Southeast Asia, India, Australia, I think Australia, I would say, is more mature. Although again, just because it's not the same scale as the US, still has some way to go. I don't know if we'll ever get there because of its size. But India is a few years behind, and then of course Southeast Asia is still a few years behind.
That's super interesting, and I think an interesting leeway into, I guess, where perhaps we can all dig a bit deeper is sort of the, what are the nuances of also startup investing in terms of categories. What you were saying, I mean, I hear what you're saying in terms of, the ASX, there's a lot of companies that list at 20, 30, $50 million dollar market caps, right? And they're relatively small companies, still very, very respectable companies and doing well and writing They have good margins exactly because of the GDP per capita thing. But India, of course, has a scale that Australia also can't match, I suppose, in terms of IPO sizes and such. One thing I noticed, and there's surely people who are much better educated, and probably you two are in some sense here, of the nuances. But one thing I noticed is that, for example, in Australia, you have these really large outcomes that are SaaS companies like B2B SaaS or consumer SaaS, even like Atlassian and Canva, that have really taken to an international stage very quickly. New Zealand has Xero, the accounting software, Xero. These are all, these have all become unicorns and really great companies, even though they were, they were launched at the bottom end of the world, down under, which is interesting. So SaaS seems to be one. There's several other companies like Hammertech. I spoke about it briefly in the last episode. There's TradeGecko. So these are companies that come from that part of the world, have done good work on a global scale and managed to eventually get exits. And then the other thing I've seen a bit in New Zealand and Australia are sort of fintech plays that service a local audience. New Zealand has a great example with TradeMe, which is sort of this local eBay, eBay plus Amazon to some extent. We can sort of order anything, or like Tokopedia here in Indonesia, that has become, and TradeMe has become a massive company. But you sort of see like a clear theme of the type of companies that are getting big there. On the other hand, in the US, of course, you have, almost every topic is being covered. Search and deep tech sort of creating some very large businesses currently, with, things like Perplexity, creating a new kind of genre for search. So a lot of the kind of big stuff that we think about in venture is still happening in the US. But the type of outcomes that you see that are successful, at least create a very large scale, in Southeast Asia and India, probably quite different again. So in Southeast Asia, ride-hailing, food delivery, general logistics sort of has become probably the largest categories in venture. But you don't see many global SaaS companies coming out of Southeast Asia, interestingly. How do you think about that? How do you think about sort of categories that you think as an investor?
Why that happens, or which categories do you think can be successful in these regions?
Yeah, I think the question is for you guys as investors, how do you look at, okay, well, I like this play, but I don't like that it's in Southeast Asia, or do you think actually, if I look at Southeast Asia, as you mentioned earlier, here are some of the categories that I think make sense here, but I probably wouldn't invest in this category here.
So I'll give you an example as far as sort of global SaaS goes. I think what we've seen again in India is that just given that how sort of cheap labor is in that sense, so there's a low willingness for companies to pay for sort of enterprise software, and hence you don't see a big local market for SaaS companies. However, just given the engineering talent in India, and there are many successful companies out of India just serving the global market. FreshBox being one example. So I think you will see more and more of such plays happening. Of course, there are other categories in India which have done well and which are attracting venture funding. One again, as you mentioned, similar to Australia, is fintech for local audiences. It's a big play. One thing in India, which is I think very unique to the country, very different from what we're seeing elsewhere in the world, is big commerce. That's seeing a lot of money come in, and very large companies being based in that space. EdTech is another area, although lately it's had its challenges because of a blowout of Byju's, as well I've heard of. Like just a jar ago, with him. So it was I think a good product, but I think probably they got a little ambitious, and again things happened in terms of financial governance, which was not appropriate. So I think things went all right there. But I think EdTech is again an important area. And then I think one area where I think India will do well, and more capital is coming in. And we had a recent exit, those people on minimalist, for second-hand haircare, which in like 5 years' time, built a company with minimal VC funding and had an exit close to $350 million. B2C, exactly, B2C company. So again, I think brands, both which cater to the growing middle class, brands which cater to rural India, brands which even cater to the creamy layer, sort of the rich, the elite. I think all have strong potential in India, and we will see more and more companies getting funded kind of address that exhaustion. I think one category where again I see a lot of promise as the country gets wealthier is wealth management. We've seen a super success of Zero Bha, which is sort of like a Robin Hood of India, where the company was really bootstrapped into a company which was valued like close to $5 billion. So you will see more companies evolve in the wealth space. Again, the challenge being that how do you acquire customers at a low cost? But again, the willingness to pay in a very low. Exactly. So but I think there's some of the categories which I think are very promising.
Makes sense.
Yeah. I mean, I think Southeast Asia has a very similar dynamic, right? Which is like, there's not a lot of willingness to pay for SaaS because labor is cheap, right? So you're not going to build a global SaaS business selling to Indonesian SMEs.
Yeah.
Just at least not in the next 5 to 8 years, right? Maybe later. And so then you have to be a global SaaS business that's selling to the US or Europe, right? Because I mean, Canva and Atlassian didn't get big selling to Australians.
Yeah, exactly.
Right? They got big selling to the US market. And you could make the argument that like they're native English speakers, they're culturally more similar to Americans. It's probably easier for them to like do go to market remotely to get started, versus like you're like a Vietnamese software developer or like a Thai software developer, and you're like, you know what, I'm gonna go sell SaaS to someone in Ohio. You have to literally move there. It's kind of like a harder bridge to cross, I think.
Are there good examples of this? Of Southeast Asian SaaS companies having gone to the US?
We have a company that sold software to NASA JPL, but the founder moved to San Francisco because his customers are all Americans.
And then it's an American company.
Yeah, now he has, like Lux is one of his investors, right? But it's two guys who went to SUTD, local engineering grads. They built software, and, it was really kind of an amazing story. Like during the pandemic, they said to me was like, oh, well, during the pandemic, no one could fly anywhere. He said, everyone was pitching on Zoom. So that's why we, these young kids could pitch NASA from our bedrooms.
That's amazing.
Right? Like that's how, but then as that progressed, it was like, well, we're not going to sell American customers sitting in Singapore. So, the founder moved to San Francisco. They still had their engineering team in Singapore. And they've been able to find good talent. They're working on a tough problem. But I think that's a little bit why, right? Which is like, if you want to sell global SaaS, then you need to kind of have that picture in your head from day one, and you need to like plan your org design and growth accordingly. And so I think it's much harder to start by like, I'm making ledger software for the corner store in Indonesia and then try to turn that into a global SaaS company, right? Because it's just the USP is totally different.
And we've seen that happen in India when people have done that, but they've had to give their sort of software away for free pretty much. And they're trying to make money by lending because they get a lot of information and data. But again, then you essentially become a lending business and then all stuff like that.
Yeah.
And I mean, you just made me think of another theme, which is like, if you think about CRMs like Salesforce and HubSpot, how they, there's also such a dominance, I think, from kind of US platforms and a lot of the sort of, well-known, well-established SaaS verticals, where they are already tools, and the startups or even bigger companies, SMEs that can afford to pay for the software, they just use the existing tools out of the US, right? So that maybe also drives that kind of vertical.
Like Freshworks is a good example though, right? Because Freshworks is like bottom up, very affordable way to compete. Like if I'm not going to be paying Salesforce, like I could go buy Freshworks and sell my company.
Right.
Or there's that, what is that ERP system that's very affordable out of like Bulgaria or something?
Oh, really?
The name will come to me. I can't quite remember.
Competing with SAP.
Odoo.
Odoo. Oh, yes.
Right? Like
the company who bought my company actually uses Odoo.
Yeah. Like, I think it's an Eastern European start, that kind of thing. So there are some of these things, right, where it's like, everyone's like, well, my market's not big enough. Like, I have to go global. What's my edge? Chief engineers. I'm going to go figure it out.
And then it's just the labor arbitrage, essentially, and you find your customer base that is okay with that.
Yeah, and they don't know, right? I mean, I bet half the people who use Odoo don't.
Yeah, exactly.
Like, there's a Singaporean company called PatSnap, and they sell like software around patents and stuff. And the founder's like, oh yeah, I put my customer service team in the UK.
Right.
A lot of the customers think it's a British company because there's some plummy Brit accent cutting at the customer service call because they don't know it's Singapore. Like you can charge more. If they think it's some Asian company, they don't want to pay.
But it's still an interesting point, though. I find, we also invested in a couple of SaaS companies out of Singapore that have largely US customers or European customers, and they're doing quite well. They're developing well, at least for sort of Series A stage. But I haven't seen many sort of really large outcomes outside of essentially food delivery, ride hailing, logistics. Those seem to be the biggest outcomes we sort of see in Southeast Asia so far, right? If you look at kind of the common suspects, the Tokopedia, Bukalapak, Grab, Gojek.
I think you have to give it more time. I feel like if you judge it on a metric of like return on invested capital rather than IPO
size or
market cap, I don't know. I think maybe we will get some good outcomes out of these software businesses.
That's an interesting point of view. Maybe a segue to the next topic, being the big venture decline, if you can call it that. I mean, we're just losing firms loosely here. In Southeast Asia and Australia as well, I've heard many people, credible people, tell me that essentially there's a lot of issues in the venture ecosystem. I mean, there's things like a lack of DPI, a lack of distributions per capital by VC investments. I personally feel, also coming from the venture side, there's a general oversupply of capital, and companies get heavily funded on oftentimes revenue multiples that are not far behind of what happens in the US. But there isn't a lot of exits. That's one example. And I think just generally there's a sentiment from angel investors that are getting increasingly cautious, and you see people who traditionally only did Southeast Asia investments now starting to go broader, doing India investments, doing US investments. How do you look at that?
I mean, from an India perspective, what I'd say, Milan, is that I wouldn't call it like a venture decline, but I think there is some clearly, what should I say, like segregation. The top 4 or 5 VCs getting access to the best deals, and they have had the successful exits. So I think a lot of the mid-tier and the third-tier VCs, they are the ones who will struggle because they don't really have much to show for themselves over the last few years, and exits have been challenging for them. So I think it's really going to be a situation where you will see some of these top 4 or 5 VCs attract more and more capital and become larger and larger. And some of the mid-tier and third-tier VCs sort of disappear because, to your point, there is just no need. So that's what I see in India. I don't think that I'd really call it a decline, but I'll just call it a bit of consolidation.
Which isn't too dissimilar to the US, right? I mean, there's sort of 10 names that everybody knows, and they capture the largest amount of LP capital. But you do have in the US at least tons of $100, $200 million funds, which there would be, I guess, mid-size or even relatively small, that are also performing tremendously well. And I think there are some exceptions in the Southeast Asian startup ecosystem. We won't go into names at this point, but there is a lot of feedback from LPs that, hey, it's really tough to make money here. And I think that's an interesting point because I think it begs the question, like, are there ways to make money? And also for our angel investor audience, how do we think about that for angel investing specifically in Southeast Asia, in Australia, in India, for those who invest in India? What do you think are things to sort of look out for as a smaller cap investor, as a high net worth, as an angel, or as a micro fund? How do you make money in that environment where you generally have overcapitalization and lack of exit liquidity?
So before I get to that, I think Cento put out a report about venture funding in Southeast Asia, and Dimitri. I think what he shows is basically that the pullback in venture in this region is basically the pullback at the late stage. A lot of which was international funds, and that deployment actually is back to kind of like 2019 levels. So I think you had 2019, and then the pandemic happened, and everyone was pumping capital in the system, and then we're kind of back, right? And so you can say it's a decline, or it's just a reset back to like, okay, the tourists have gone home, and we're kind of like back to everyone who was here before is continuing to do their thing. there are larger funds now, right? People did raise larger funds out of that, and I think the DPI concerns are real, but I think in terms of like who's still here and like who's still writing checks, I don't think that has changed too much in the early stages. On the second point, right, which is like, how do you make money if you think liquidity is challenged, or like how do you pick if you think it's overcapitalized? I think you kind of have to go back to basics, right? Which is like, what's your entry valuation?
Yeah.
Right? So if you think that the median outcome of a Southeast Asian fund company is 100 million M&A, you can't pay 10 pre
Yeah.
or 20 pre.
At a seed round.
Right? Like that just the math doesn't work for you, right?
Yeah.
So then I think that's kind of how you manage your risk a little, is like you can control your entry valuation, right? It's like, well, I'm not going to do that because that doesn't kind of make sense for what I think the median outcomes are going to be. Unless there's some story you can tell yourself about why this is different, right? Like, okay, this isn't a Southeast Asia only story. This is going to be a global story, or like, something that
It is going to be a huge outcome for whatever reason. But
yeah, but there has to be something I think you have to like tell yourself or like believe to be true. So I think that's one, is like controlling your entry price. I think the second one is like, and maybe this is a very human thing, people want other people to validate their decision. Oh, so and so is in, so and so is in, and right, like that's why we use the borrowed credibility of other people. We're like, oh well, the founder of Hot Startup you've heard of is an investor. Like this person, we all do this, right? But then there's also the human reaction, which is like, well, if everyone is in, the demand for the deal goes up, the price goes up, right? So then it's like, is that the dynamic you want to be in, or is there something where you're like, okay, actually, like I know a lot about this space, and maybe no fancy people are in, but I think this is the right approach to attack this problem. And I'm willing to make a bet. And I say that there's something different here, right? Because that's the reward, right? You're being rewarded for thinking something different.
Right.
But I think sometimes the human tendency, the only person here, like something.
But that goes back to Peter Thiel, kind of, low conviction, high consensus investing, which oftentimes, I mean, there isn't a lot of great stories that pan out that way versus sort of high conviction, low consensus
Yeah.
thinking, which I think is interesting. I feel like there just aren't that many really great examples of that, of like really high conviction, low consensus investors doing very well. I mean, there are some isolated cases, I suppose.
But yeah, so I think I did an analysis at my old fund on like our best deals, and like basically, when all the partners agreed or all the partners disagreed or one partner was really, all that kind of stuff. And it was basically that. The best performing deals were basically where half the people were like, this is dumb.
Right.
And the other half were like, no, you don't get it. And then
Yeah.
they had to like talk it out till they all kind of got to a place where it's like, okay, fine.
Yeah.
And I think that's what it is, right? There has to be something that isn't priced in. So what is that thing?
But was that more sort of in the US or even in Southeast Asia? Because, one of the challenges, which I see in India is just given that while the market seems big, it's just given the purchasing power and the fact that when you look at a market for a tech business, it's really 70 to 80 million people invest. Then there aren't too many such sort of hidden spaces where you could make money because the market depth is just not there. So I'm just wondering if that's a US dynamic, Southeast Asia dynamic, for both.
It's an interesting question. I mean, this was when I worked at a US fund. But I guess, I don't know, as like a student of economics or business or whatever, I guess there has to be something you believe that others don't. Right? Or your non-consensus view is that you got there earlier. You were willing to make a bet before other people saw it and bid you up. But if like, I guess if we all sat around and we were like, this is freaking amazing, like we're all going to pile in, then it's going to raise the valuation, which kind of caps our upside, right? So I don't know. I haven't done a lot in the Indian ecosystem, and that's something like I would love to explore more with you. But yeah, I would love to. Maybe I'll come back to you. I'll do some research and come back.
I mean, that's an interesting point. And I mean, capital also at some point does become a moat, right? So you do see companies that sort of do relatively equally well, and then one company just gets a lot more funding and they can do really well because they have the ability to market.
Disagree.
It's categorically or
I think that decision-making quality deteriorates
the way
when
cash.
you have too much money.
Yeah. Yep.
No, look, I think it even in India, we always say that you've got to go raise a lot of capital because there will be a Tiger Global or a SoftBank will just come in and write $100 million check, and then you just can't compete. And I think I agree with Shiyan that what that essentially does is that it reduces the quality of decision making. Your bar for what you should be spending money on versus not just goes down significantly, and it just becomes a lot more lax. I think being capital constrained for the early days is far better because if you think of unique solutions and different ways of addressing challenges as opposed to just throwing money at it, and a large check can actually make you lazy as a founder, where you're just kind of throwing money at the problem as opposed to thinking of sort of unique solutions. So that's actually doing always anymore. So the negative split scaling, I think, is also something. Yeah, there's a lot of
And consensus that's not working very well. So
exactly. And if someone gets funded, it makes all the mistakes. I think for a person or startup which come after can learn from all the mistakes.
not plus with capital.
It develops the market. They said that money educating people, but they weren't able to monetize it. So I think I'm a big believer like constraints. So like I've seen this in some of my companies, right? Like they were like really frugal. Then they raised a big Series A, and then they get excited. Okay, I'm ready. I'm gonna go hire 100 people, and I'm like, stop.
Suddenly they have a bellfire driving their stuff around.
Like,
and
pause. I'm like, no, that's not what you do, right?
Yeah.
Not because you need to think. You're like, okay, you want to list down all initiatives that you think are going to move the needle, okay? And then you're going to prioritize them, right? But you imagine if you had $10 million versus $100 million. Like $100 million, you're like, I can do everything. And then what do? You hire a bunch of people. Then you get bogged down in onboarding them. And then there's like cultural conflict between the old guard and the new guard. And then you spend all your time in meetings aligning people instead of like doing stuff, right?
yeah.
So like that to me, that like I have a very big allergic reaction to this, which is like, of course, you don't want the opposite, right? You don't want that guy who's like so cheap they never invest ahead. But like on balance, I don't totally believe that capital is a moat thing. Well, I mean, it's abused too much.
It's abused too much. I see your point, and I think you're very right. I mean, in that sense, I know it for myself as well. I think having some level of capital constraints is creates financial discipline, and I think that's super important, and that gets lost a lot in overfunded companies. And there are a lot of like glorious failures as well, right? Of capitalist risk. There are a lot of those examples, right? But I think on the other hand, we also can't forget that if you look at sort of unicorn-sized outcomes that really did generate liquidity for investors, I would argue, without having any report in front of me, that more of those companies than not have raised sort of more than $10-20 million, at least some much more. So in that sense, I still feel that capital is a moat, but probably more so in the traditional power law outcome kind of thinking, right? And then you need that combination of very disciplined founders that have good fiduciary management and governance and so forth, as well as a lot of money, right? And that together, I think, can create large outcomes. And there's some.
It's also depend on the stage at which that extra capital comes in. If you go into early on, then you risk that financial indiscipline. But I think if you're established product market fit, you're seeing the business scaling nicely at that point in time, a large infusion of the capital can actually get you farther in the long. Makes sense. Stage makes a big.
And actually, I mean, specifically when you figured out unit economics, right? When you figured out product market fit and you actually know I can invest this much at this pace and this is my return on investment, right? I think a lot of the time what happens is founders get too much money too early. They actually haven't figured out product market fit. Unit economics aren't positive yet, and then they start scaling in a bad way. Right? That's the other thing, which even can be non without bad intentions. It's just that truly the thinking isn't correct yet.
Yeah. But it also is bad for founders.
Yeah.
Because you raise $10 million too early. You cap out and your business is a $5 million annual revenue business. How do you get out?
Yeah.
Like, you can't sell for a number that makes money for people.
Enter the zombies stage, right?
No, but that's your 1x pref. That's it, right? Like, you don't make any money, right? Versus like you raised $1 million, you get to a $5 million revenue business. There's still a good outcome for everyone.
I think that's some very good advice from Shiyan here for all the founders listening.
Right. true. But later, right? Like if the thing is like a rocket ship, you're like, yeah, go raise that next 10 million, right? But the timing, I think, does matter.
I mean, that brings me to another point, which is perhaps related and also goes back to the earlier conversation around, the Cento report that a lot of companies, big ups to Dimitri here again, a lot of the exits in Southeast Asia, especially, I think India has much more larger outcomes, but a lot of the outcomes in Southeast Asia that are actually very positive for all people involved, for founders, for investors, are more around sort of 100 to 200, $250 million mark. And there's nothing wrong with that, right? If every dollar invested on average gets X multiple, that's a great thing. And I think you're right also in your point earlier, maybe pushing that into a slightly different angle. There's also this founder education piece. You don't have to necessarily create a unicorn, right? I think a lot of people go into it and they think that it has to be a huge thing. They have to tell this huge story, but really it's just having a disciplined path to getting a decent sized outcome, and there's nothing wrong with $100 million, $200 million exit, right?
It's pretty nice. It's like that's generational wealth.
Exactly. Well, and the other question that begs, I guess, is also what does that mean for, if you look at very large outcomes, there's a huge tech mode usually. So there's like, if you think about Google, Facebook, etc. So tech is kind of at the very center of what these companies do.
Yeah.
But now you have, Kopi Kenanga and my good friend Chris and James, and they've done a fantastic job here in Indonesia with, for those not familiar, essentially a coffee chain that's sort of better priced than Starbucks. I think they have over 1,000 outlets now. And that's not really a tech business at all, right? It's a coffee shop business.
Starbucks was venture funded.
Yeah, it was venture funded?
Yeah.
Okay.
Staples was venture funded.
Right.
FedEx was venture funded, though I think only the Series F investors made money. But
so I think that's an interesting question. So can non-tech companies be VC companies? And is that maybe an area that VCs and also angel investors should look at more actively in these markets where outcomes are more of that size? And is there a correlation between that? I think that's an interesting question.
I mean, maybe it just goes back to the question of like, what does venture capital really mean, right? And, does everything have to be venture funded? Does everything have to be a startup? No, right? You can call it different things. It like doesn't really matter, right? But I think the only reason you lock up your money for 10 years and take that level of risk is because you think there's an potential for an outsized return, and that fulfills a specific part of your total overall portfolio allocation strategy. So like, if it doesn't meet that criteria, then I think you need to underwrite it differently, right? And you're not willing to be locked up as much, and it would be structured differently, right? Like if you think it's like, okay, this is essentially a retail business, I could model the unit economics per store, these things break even and start turning profitable within 8 months or whatever it is, like, then it's like, okay, well then I would structure it not like as a safe or whatever it is, but I would structure it so that, there is a payout, right? There's a dividend payout and it happens and you have to distribute however much, I don't know what it is. I didn't invest in this, so I haven't looked at it. I don't know anything about it.
I think my view, Milan, is that some of these businesses we spoke about, which sort of, don't scale as quickly, they take time, but tend to sort of generate more cash flow. They may or may not be sort of venture funded in that sense. But I think increasingly, long-term sources of capital, such as family offices, I think that's a good source for such businesses because sort of there is no pressure to return any capital. It is patient. Sometimes the wealth creation which has taken place in these family offices is a function of a more traditional business. So they understand the dynamic a lot. So while they may not be venture fundable, I think there are, to Roshan's point, there are all types of businesses and which require funding, but maybe not from the traditional VC.
Yeah. Makes sense. Although, interestingly, I believe there's now a sort of general observation that can be made in Southeast Asia, specifically in some of the kind of name brand VCs like East Ventures, Jungle Ventures, Open Space, etc. Some of the bigger investors here who've raised multi-$100 million in perhaps multiple fund vintages that are going into more what I would call sort of almost micro PE style investments. So that, to me, that seems like it's starting to become a bit of a theme. At least we see various examples. I mean, there's EV bike companies, right, that are pre-product at relatively high valuations in Indonesia and Vietnam, etc. And and VCs really are competing, I think, for some of these rounds from what I see. and there's ice cream companies, there's coffee companies, and so forth. So I wonder if there is a sort of natural response also to seeing that it's actually not so easy to build pure tech businesses because of what you said earlier, that not everything needs to be technified because cost of labor is so low, AOV is low, etc. So I think there's an interesting space in general. We are increasingly interested in looking at perhaps tech-enabled businesses that have physical elements. I think there's something interesting there.
Yeah, I would agree. I mean, if you have a fund and you're being paid to deploy it, you gotta find ways to make money, right?
Yeah.
So I think you gotta work with what you have. And I think to the extent that you are in a place that has low per capita GDP and maybe isn't always gonna out there to like buy software, then you have to ask yourself, okay, well, what do people spend money on?
Hmm.
F&B, right? Everyone's got to eat. Doesn't matter, like, economy's up, economy's down. You're talking about ride hailing, transport. That's why people do those things, right? Ag. A lot of Southeast Asian economies are still very ag focused. And then I think at the end of the day, it's still financial services, right? Like that infrastructure has to be laid. So I wouldn't be surprised to see more deals that look more private equity-esque in these spaces. And in some of them, it isn't necessarily that our first thought has to be the whole thing has to be all tech. So, like, I mean, one example I like is Time Bank, which is actually a South African bank. It's a South African neobank, and it's, I think, one of the 5% of neobanks globally that is profitable. Just tells you how many unprofitable neobanks there are.
Yep.
But their innovation was that you don't sign up online. They partnered with grocery stores, and you sign up the kids.
In the grocery store.
So it's like an Android screen, and you go there and you sign up yourself, and they print a card for you. There's like a printer inside, and they print a card for you, and you can cash in and cash out at a grocery store. And there is a person there to help you. They're not going to onboard you, but they're there to educate you about financial products and services. And so you're like, wait, is this like a technology play? Is this a neobank? But I think it's a very good understanding of the consumer and where they're at on like, how do I lower CAC? It isn't by running Facebook ads to convince someone to download an app and then sign up for a financial product. Like that would be too expensive. Actually, where does somebody go all the time? The grocery store. Where does they already have cash? The grocery store. And let me put, and so
Makes super sense.
it does, right? But it's online, offline type of thing, but it is way cheaper than a branch. And then once you've got the person onboarded, then you start the education and then you do all this. So now, they're in Philippines, they're launching in Indo, Vietnam, so I think that's what I'm like, this sort of like, what is tech, what is not tech, what is VC, what's not VC, right? But it's like, so what's the innovation here, right? It's just like, I'm still like using technology to largely cut out all the costs of running a bank, but I'm not slavishly doing it, right? I'm meeting the consumer where they are to onboard them in a cost-effective way.
Makes sense. I mean, I love that. It's not everything has to be an app.
Not everything has to be. There's an example even in India. I think to Shiyan's point, this company called Lenskar, right? Yes. They started out with trying to sort of find your spectacles, online, where you had this facial technology where you could try on scanning your face, etc. They would send people to your home to eye checkups, etc. And sort of as people started adopting them slowly, they realized there was a limitation in terms of how they could scale that. So they went into bricks and mortar stores. Now they're like multi-billion unicorn, and just on the back of this whole sort of online offline. Another example is a company called First Right, which is a company for selling sort of wavy products. Again, started out as an online business. As they scaled down, they raised a large round of capital from SoftBank. Well, it completely went bricks and mortar. So I think especially in emerging markets, where people are still not very comfortable to be fully online, I think this mix of offline, online is important. But again, I think your unit economics need to really work to be able to support that offline spend.
Makes sense. Actually, that reminds me, I saw a video by a sort of, American business influencer. I can't remember now the name. It's one of those guys that I think, the inspirational guru type content creator, but it was very good. And he had a piece where he was saying, I love seeing people get rich of the strangest stuff. And so he makes these examples. There's one example of this, some guy in the US, and he, in the pissoirs, male toilets, were standing toilets. And there's a guy, and he was one of the early guys who invented these little kind of rubber pads that are like anti-spray back. But you pee on them, and that doesn't make a mess. And apparently he's become extremely rich from it, right? So he's kind of patented a certain shape and got it produced in China. And I mean, you wouldn't think of that as a venture case, but it is a great venture case, right? If the guy managed to win a huge business out.
Well, safe, very similar business. Well, yeah, for women, yeah.
I think that's fantastic. But I mean, maybe step to step change so we don't get stuck on this topic here of toilets. So what
Does
is
it have a smart toilet investment?
you do have a smart toilet investment? Ooh,
Yes.
now I want to hear more.
It's like a sensor in the toilet, and because you can actually do a lot of early detection of disease
Oh,
from excrement.
from your pee or from excrement? Okay,
Yeah.
wow.
Right, like sometimes people will ask you for a stool sample, right?
Send me the deck.
The daily stool test is
Essentially, is you could just have a baseline of that and your urine, right? Because there's urinalysis.
Amazing.
And that actually is more like early warning, right? Not before like something is wrong, right? It's like when people like, oh, you see blood in your stool, like you probably should.
Also see something's wrong.
Right, yeah, kind of thing. So, yeah, my partner Eric did that deal, so it's kind of interesting.
That's cool.
It also has a great name.
Yeah, I mean, actually, Adron. What is it called? Throne. Throne. Well, I love
Is
it.
that a good name?
That is a good news. The Throne. I think we did some marketing for them just now. But yeah, I mean, it's interesting. A lot of the times, some super successful businesses that just drive really great shareholder value are in very unsexy spaces. Maybe now shifting to a last topic about a very sexy space at the moment, which is AI. So what do we think does AI do to early stage startup investing, especially in the context of, are there certain verticals that we think AI will just have the propensity to eliminate human labor to an extent where, traditional startups may really struggle to compete on one hand, and also what do you think are sort of the areas within AI early stage investing specifically that, outside of the LLMs are sort of, have a good chance of becoming sizable businesses that aren't going to be owned by the large incumbents like, Facebook, Google, whatever else is out there. Love to get your points of view on that, because I'm sure our listeners are interested in AI. Everybody's talking about it now. We're all investing in the big companies through our business.
I think one of the things I see at a more sort of general level with AI is I think speed to market may go up because if you integrate your products, they are critical. Second thing is cost to get a minimum viable product will also go down significantly. And I think we were just talking about it a little earlier about how you can scale up to $100 million ARR business. Very few people. I think that's going to be a fundamental change. I think in the initial years, companies built up the application layer with sort of help people do their job better as opposed to completely replacing them. I think they will do better. And then, being in the marketplaces business myself, I think with AI, I think, priceless will be matching, etc. will become much better. So again, they're going to see sort of a rebirth of, I think, marketplaces again with AI. But I think barring sort of investments, huge investments going into the foundation layer for AI, I think the cost of applications on top of those will have much lower sort of capital deployment and time to market become much sure.
I think it's gonna be like the internet, right? Remember the old days, or we're old enough, where like some restaurant would like put their menu up on the internet and it would be like some PDF, but wow. Please. And now you're like, of course you would be, but like who would not be on the internet? So I think that's what AI is like. Everyone will use it.
You need to stop with those PDFs on QR codes. I mean,
yeah, but I think AI is like that, right? Like everyone will use it, and you're not going to call yourself an AI company. It's just a tool. Like we don't say we're Excel companies. We all use Excel, right? Like it's just something you're going to use to run your business, and the cost. Like so, I think if it like the cost of intelligence goes down to zero, what does that mean? What becomes more valuable? Distribution becomes more valuable. Strong product thinking becomes more valuable. Partnerships become more valuable, right? Like it was just distribution. And so agree, right? It'll just be so much easier to ship something. Like the internet made it so much easier for people to publish something, but then discovery was the problem, right?
So distribution, yeah.
Which so then like Google won that value, right? Which was like, okay, anybody can be online, right? Like we can all write whatever our thoughts are, but is anyone gonna read it? So same thing. We can publish apps till the end of time, but who won? The App Store captured the value of all the apps that are being, right? So who's gonna be the pointer system for all of the new things that are being created? How will people discover? I don't know. I think the agentic stuff is super interesting, right? Which is like, as intelligence goes down to zero, we can automate even more of our desires, whether it's price discovery. I want to find a house. I want to sell a house. I want to find a buyer. Like, I don't need to go through maybe
The portals anymore.
or a broker, that kind of thing. I think those are like pretty interesting, but it's early, right? Because there's like, I don't know, do I trust a random agent to go negotiate on my behalf? Who knows what
Yeah.
this bot is going to do?
But it's very interesting you brought up real estate, because being in this space, I always think about what sort of might play out for portals like us. I'm like, right now, anytime there's a home which comes to the market to be listed, agents put that on our platform, generate leads. When the leads get passed on to the agent, they go out and close the transaction. Imagine a world in agentic AI when you simply tell your real estate, the AI agent, I want a property in a particular neighborhood at a certain price or following amenities. That goes to all the agent website, the real estate agents, and pulls out all the listings from there. And comes and presents you with something that you exactly want. And then if you say, yes, I like this, actually the back end go and schedule an appointment for you and you want to see that. So I think the power actually might shift from the portals to potentially the brokers, because the real world experience of buying a home is still quite broken. And so the quality of the service provided offline actually it might become more important than the service portals provided to it. So that's an area which is interesting. It's foreseeable.
Interesting. So does that mean you think that the sort of service layer between the more traditional, pure sort of visual platform listing, or kind of board with a bunch of notes on it, kind of Web 1.0, Web 1.5?
Yeah, very. What is this? So 1.20, where sort of there is collating information and presenting it in a nice way. And that's what the value is. That I think potentially might disappear. Value there. There's a value there.
And it's the service layer in between to the consumer that can capture a lot of the value.
Where it's harder for AI to disrupt, because it is an offline experience which is still necessary in the process. That's interesting.
What are some examples that you feel where AI has the ability to create sort of new verticals or replace verticals within the kind of tech startup ecosystem that are interesting? Or maybe more specifically, as an angel investor, again, I'm sure we have many angel investors here listening. What do you feel are some of the areas that you are interested in angel investing into within AI? As one example, I'm really excited about, of course, agent layers in various forms are super interesting. I think also one is sort of the digital twin model. We invested in one company. Shout out to Justin here from Cloud Kitchen, and Adriel, or ex head of investments. He joined them as a COO. And they have this super interesting model, basically cloning sort of YouTube influencers that then talk to your kids while they're playing Roblox. I mean, when I first heard this, I was like, this is ridiculous. And I talked to my son about it, my 10-year-old son. He's like, it's amazing. Can you pay for it? So that's super interesting, right? I mean, that would have not been possible prior to AI, but it's a sort of a completely new world of things that to me seem so non-intuitive, So are there some examples that you think are interesting that you are looking at now that you're potentially even actively hunting?
So I think I like those things where it's like, what are humans really good at and what are machines really good at? And how do you take these humans and amplify them?
Mm.
And so I guess I always think about where can you drive costs down so that you can grow demand for the thing, right? But you're still providing a great experience. And like mental health, I think, is one. So there's a lot of people who are like, oh, I'm going to have a mental health marketplace. I was like, yeah, but you still have the same problem, which is like that the human is like, you only have so many hours in a day, right? So it doesn't really scale the way that you want it to. But I've seen some where like the therapist can train an LLM that is in their specific therapeutic style and basically provide all of that intervening support. So like, you're not only going to therapy, like you don't only have a crisis that 1 hour a week. You have a crisis, something else. Well, how do you talk to them? Well, so it's basically like extending the therapist's reach to be able to do more and more and only bubble up, when it's like, okay, now something is wrong. But you're basically saying like, hey, here's all the conversations I've had with this patient before. Here's the treatment plan I have them on. And I am like helping them day to day and also coaching them on the things that help. Like, okay, did you do your morning affirmation? Did you get out of bed? Did you, all the things that like as a human, it would just be like impractical for you to be able to do because you're in my seat. You're basically the team to like do all this stuff. And now you have a team of like
agents. And the idea being that the incremental cost might only be 20-30%, but the incremental revenue might be 100%.
Yes.
But
it can really scale.
It fundamentally takes over the problem of scalability. It's I think not just mental health, but I think across the healthcare system. I mean, you talk about general wellness, right? You look at lifestyle coaching, like suffering from obesity, other lifestyle diseases. And what they really need is sort of a coach who's constantly egging them to sort of not fall off the wagon. Right? And that's almost impossible because you have these boutique businesses built by these wellness coaches, but they never scale up beyond, let's say, 50 customers or 100 customers. And now I think this whole augmentation which Shiyan just spoke about, where one person can now actually handle like, hundreds of consumers because of the sort of the first level interaction on a daily basis that happens through an AI agent as he was doing. So
makes sense.
But it's trained, right? It isn't a robot. Because if you thought it was a robot or a pure robot, you would ignore it.
You wouldn't like it. I mean, it's like the kind of checkout, at the airline websites, the checkout bot.
Yeah.
Or you're trying to change a booking and it's a nightmare.
Yeah, you want to scream at it, you want to throw it on the ground, right?
Give me a person.
Yeah.
Yeah.
But I think they're smart enough now that they can actually do a bunch of stuff, and that's only going to get better. And so I think
fast is getting better fast.
Yeah. So I think those are like pretty interesting, is that you can really take what is deeply human about someone and help them amplify that and take away a lot of the other stuff that's like, less value add, I would say, but it's still valuable in the scheme of the total service you're providing.
I want to quickly come back to something we talked about offline earlier, and you mentioned more sort of B2B use case, which I thought was super interesting around this sort of training, taking case files of past, I think, judges or
oh yeah,
media. That was interesting. Can you explain that, Beauty, for
I think people have talked about education use cases for AI, right? Like, can you talk to your AI? Can you practice? And I was having a conversation with someone. They're like, what if we took all the like case files of judges, right? Like every case a judge had ruled on, and you as a lawyer who's gonna argue in front of this judge could practice your arguments. And based on what that judge had done in the past and, precedents and case law, the AI could come back to you and be like, I don't think the judge would look favorably upon this because in this case 5 years ago, they ruled this way.
And you kind of train your argument as well, right? So you could go
and it's like deliberate practice, right? But actually against an opponent that you're going to interact with. And you can imagine this in like lots of different situations where you can practice. So like I've seen sales use cases where it's an AI training, like a call center salesperson. I'm selling you insurance. What are your objections? And instead of practicing on live leads and burning a lead, why don't I practice on an AI instead first and get up to speed? And it's like smart enough. I'm not even practicing my sales manager. My sales manager only has so many hours in the week.
Yes.
If I could actually practice on that, actually would be pretty cool. And we have one that isn't exactly the same, but it's on zoning and permitting. So in the US, zoning and permitting is done at a very local level. And so if you're a developer and you're like, okay, I want to build a mall here or whatever, you have to go like look up what the specific zoning and permitting is in that space. And so what this company does is it sucks up all of that information plus the hearings, because there are these hearings where people present their case
with the local regulator.
With the local regulator. And so you as now a developer could actually check with the AI, like, I have a plan to do this. What's the likelihood that I would be able to get this through before you buy a piece of land or before you commit any resources trying to develop it, right?
That's super cool.
And so like these are things which I think are cool, right? Which is like things that basically would be too voluminous for a human being, too much tacit knowledge, physical, right? To deal with, then you can be like query with confidence that, okay, I have the whole case log. I have every objection that has been ever raised about, the salamander on this ground before I try to build a building here.
Yes.
And there's a similar startup which I came across in India, which basically uses AI again during the building design phase and tries to optimize the building design to ensure that you have the maximum flats which are sort of Vastu compliant, which is the equivalent of Feng Shui,
Yeah.
and also maximize for flats which are favorable from a consumer standpoint facing a certain direction, because people are very particular about that in India. South facing, exactly. So it just optimizes the building design for ensuring that your sales value, that building gets maximized. Simple optimization problem, which is using AI. So I think there are going to be some fascinating use cases. I think, but the risk is that how to build a moat around a business like this. I think that's a bigger challenge because as we discussed, because if it's too easy to build, it's too easy to build because the cost will go down, time to market will go down. You will have many copycats get come, and if they have a smarter idea around distribution, to Shiyan's point, they get very quickly disrupted. So it's going to give you opportunity, but at the same time, it's going to become more tough the better it's done.
Makes a lot of distribution is a piece, but then once you're in there, then you need to vertically lock into their process, right? So it can't just be like it's as easy as switching different tabs. I'm like, oh well, I put this address here. Can I build here? Can I not build here? Right? It has to be like, okay, I'm gonna go understand like from permitting all the way down to construction, what are the things I need to do so that I can deliver value.
And you lock in the consumer through a very vertically integrated process for whatever the consumer outcome is.
Yeah, that
Makes
makes the
sense.
boring work, but very important work.
Again, unsexy. The unsexy stuff with AI.
The same, great high switching costs essentially.
Yes. Makes sense. Well, to all the founders, lots of good advice here from the more experienced investors here in this little circle of three. I've also learned a few things, and I think we'll call it a day for now. We have to go to the beach now.
You're gonna now melt.
If
The sun is like steadily moving this way.
Okay. Well, thank you for joining the second episode of the Accidental VC, where we try to pull apart different topics within the VC investing ecosystem across Australia, New Zealand, and Southeast Asia. Please give us feedback. You can send us an email to podcast@nonpublic.io. We'd love to hear more from you, and we'll see you back in 2 weeks. Thank you, team.